Our goal is your satisfaction. Let us show you the way.
Should you buy stocks during a correction? It's easy to think of a stock market correction as a bad thing. But actually, during a correction, you have a prime opportunity to scoop up quality stocks on the relative cheap. If there's a company you think has solid potential whose value is now down as part of a broad market downturn, then it's probably a buy. How do you survive the stock market crash? 5 key tips to survive a market crash. Take a long-term approach. Everything starts with embracing a long-term mindset to your investments. Use dollar cost averaging. Avoid margin debt. Diversify your portfolio. Keep funding your account. When was the last market correction? The last time the S&P 500 entered a correction was February 27, 2020, when the market was being whipsawed by fears about the outbreak of the COVID pandemic. This time around, investors were wrestling with escalating tensions between Moscow and Kyiv, which could devolve into a full-blown war. What is considered a market crash? The technical definition of a market crash is that stocks fall by 10% or more in one day. They are often caused by a mass panic in reaction to an event that prompts several investors to sell stocks at the same time, but they can also be associated with economic downturns and other factors. What percentage is a market crash? A correction, usually defined as when major stock market indexes drop 10% to 20%, historically happens relatively regularly, often triggered by panic selling. A crash is usually defined as a rapid drop of 20% or more. But not all crashes are the same. How long does a bear market last? Bear markets tend to be short-lived. The average length of a bear market is 289 days, or about 9.6 months. That's significantly shorter than the average length of a bull market, which is 991 days or 2.7 years. Every 3.6 years, that's the long-term average frequency between bear markets.
Take our lead. Let's help you make your mark.